It is Tuesday, December 10th, 2024, and it is time for this week's episode of Navigating the Markets with me, Markets and Mayhem. And this should be a fun one. Got a lot of ground to cover. I know folks are watching these markets carefully. There is some degree of concern out there as to what all is playing out, although it's been a very, very modest pullback overall. But we'll dive into the details and talk about what I'm seeing and why I think it matters, and also where there are opportunities and where there are risks out there. Speaking of risks, here's our quick risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. Now, a little bit about me for those who aren't very familiar with my work. My trading journey began in 2005. That means next year, I'm really dating myself here, I'll have traded for 20 years. I had someone who was watching my bookmap stream earlier remark to me that that's their age. And so I immediately felt a little bit dated, right? But they also remarked that it's nice to be able to learn from someone with that level of experience. So that made me feel pretty good. But I've been trading for a while, started in 05, started investing in 06, really rolling profits from trades into investments. And quite frankly, I think that's a really important thing to do. If you're making money trading, you shouldn't just be gambling larger and larger amounts. You should take some of those proceeds and invest it into stocks, into fixed income, into real estate, into a business, buying a piece of a business, starting a business, whatever, just diversifying, right? All the best traders I know have been doing exactly that, rolling profits. I did navigate through the great financial crisis, and really through sheer luck, and this was a long time ago, I was able to get out of the way from it because I saw what could have been a potential double top, and I just said, you know what, I'm just going to get out of the way of that, and maybe if it moves higher, I'll have to buy back at a higher price, but if it doesn't, you know, we could get a bit of a correction. Instead, well, we had a much bigger correction. Of course, things got kind of wildly out of control from late 2007 into early 2009. But that gave me a great appreciation for just how important it is to understand the larger mechanics in the markets, because what I was seeing in the charts didn't tell me the whole picture. And I have a pretty curious mind, as you probably noticed if you followed me for any period of time. So I really felt like I wanted to learn what was driving all this, what all was going on, how does this whole system come together, these puzzle pieces like the micro or fundamentals and what's going on in specific industries, all the way up to the big picture, or what people call the macro, the flows, or where money's going from, where it's coming to, where it's coming out of, you know, the monetary policy outcomes, the fiscal policy outcomes, all of that stuff combined with understanding more about the technical side. So I felt like there was some more nuance needed. And so I spent that time, and what better time when the whole financial system is sort of on shaky ground, where you're seeing some of the plumbing exposed before your very eyes, to learn more about that. So back then I was a discretionary trader. I evolved to become more systematic in my approach over time. So my approach is now driven by a combination of factors that I can qualify in models that I backtest based on different assets and their personality, but it's generally a combination of momentum, price action, options flow, sentiment, positioning, volume profile, and the big picture. It sounds like a lot, but it's actually not when you really start to put it into a more codified approach, right? So I backtest and build my own models and systems, and I trade a variety of asset classes, and that allows me to be a little bit more flexible. If something is liquid, if it has momentum, if there's some sort of thesis there that's driving it, that can continue to drive it, that's when I start to get more interested. I began working with Bookmap in early 2022, and I want to mention that because they have a great sale going on until next week. So if you haven't checked that out, you can find that on my feed. And I co-founded Traderade in 2022 as well. So we're going on 3 years as a company, coming up in just a few weeks. It's pretty remarkable. A lot has changed. We've grown a lot. And I think that over time, we're getting better and better and offering a much more compelling value proposition. So with that all being said, let's get into the market overview. There's so much going on here. So I'm going to try to start off with some of the stocks and the indices, and then really zoom out to the bigger picture. And then we'll go back to talk about some of the opportunities that we looked at last week and where they stand now. And if, as you're watching, you have any questions, feel free to put them in the chat, and I will get back to them as we get closer towards the end of the presentation during Q&A. The first chart we have here is Google. Powerful move today. Company announced some big breakthroughs in quantum computing. This scared some people, quite frankly, and I'm not so sure that it's warranted. That is to say, there's a lot of fear that we're going to have imminent breaking of all modern encryption, as that may implicate cryptocurrencies, as it may implicate encrypted data that's being stored or at rest, and data that may be transmitted or for communications. The reality is we're a long way from that, probably at least 2 to 5 years before that becomes a real prevalent concern. There are much more practical things in the security world to be concerned about to govern your attack surface, where you may be vulnerable to exploitation that can undermine the security of your money or your communications or your data or otherwise. So I would suggest looking at your systems, your networks, your cloud presence, your own situational awareness about cybersecurity before freaking out about Google's new quantum computer that probably won't directly impact you at any point, anytime soon. Quantum is a forward risk for encryption, but we also have more encryption algorithms coming online, things that are quantum resistant, like Kyber, that buy us some time so that when quantum is finally able to run more complex tasks over time, you'll probably see that become more prevalent. So I think it is going to take a little bit more time for that to become a more realistic threat. But for now, it's important to govern what we can, which just means use two-factor authentication, use strong passwords, encrypt your calls, your video, your text, and otherwise, because we know all the telecom networks have been completely hacked. And just be cognizant of the threats that exist out there. Patch your systems regularly, use best practices, employ ad blockers, that kind of stuff. Control what you can. And for the infrastructure you can't control, that's out of sight, out of mind, just be aware that behind the scenes in the private sector, they're already adopting quantum resilient encryption in banking, in the military, and in a number of other industries. Now, the next stock, Meta, also looking pretty good overall, probably stalling out on momentum just a little bit here. But, there have been parts of the market that don't look so good. But some of these really large tech companies have made a kind of violent comeback since November, many of them making new highs on the 52-week or all-time basis, like Meta here recently hitting a new all-time high. So momentum still looks pretty good. It's fading a little bit here, but as long as it's above the 20 and the 50, it still overall looks constructive. Tesla also making a new all-time high briefly today before pulling back, but this stock also showing some pretty powerful momentum. You can see a lot of this started after the election. There's a lot of optimism that Elon Musk is going to have more preferential treatment, that there's going to be more room for self-driving autos and some of the other initiatives that could benefit Tesla. We'll see what comes to fruition. This is a stock that sometimes trades a little bit inverse to its fundamentals, but nevertheless, a lot of excitement here. One word of caution with Tesla, I would say, is that we do see call skew getting a little bit blown out to a bullish extreme, which would simply suggest that it's going to be heavier lifting, right? Fattens that left tail risk a little bit, but it's heavier lifting for bulls to keep price moving higher. Acts a bit as a drag on price. So it's had a great run, maybe a good time to maybe take some profits or look at some hedges, but overall, definitely a strong run in Tesla. Apple, another one, pushing to new all-time highs recently. And, again, just this theme in tech of these companies really roaring back from November. So there's a lot of bullish animal spirits, a lot of optimism. Retail poured a record amount of money into funds during November. We'll talk about that a little bit later, but a lot of those funds are either passive, or if they're active, they're weighted with these very large companies being primary allocations. So a lot of money came into these companies during November as well. And of course, buybacks are starting to kick back in full speed, which is helping too. Amazon, another one that recently made new all-time highs. Remember, the ceiling was 200 for a little bit when Jeff Bezos was selling around that level. We've now seen him pull back on the selling and the stock break out pretty decisively. So again, strength in mega cap tech, a bit of a theme. But that's not a theme in all of mega cap tech. So NVIDIA is showing signs of deteriorating momentum. It does look just a little bit like it might be trying to put in a head and shoulders top. Obviously, it hasn't yet really cracked that neckline, so we're not there yet. But what concerns me about the price action over the last 2 days is we've now cracked below the 20-day, then rejected the 20-day today and closed below the 50. Those are not the sort of things you want to see in a stock that's really driven by momentum in no small part, right? So this could turn into either a consolidation period if we don't break below that neckline and create a head and shoulders pattern, or we could have a bit of a correction down to say 118, 116, or maybe even a bit lower than that. It really depends on if we have a broader market sell that creates more distribution pressure in NVIDIA. But what's causing the stock some pressure of late? It's a risk I identified back in July as a sort of late 2024 to 2025 story. It's the idea that the company, its monopoly, and some of its anti-competitive practices could be called into question by regulators. We've seen murmurs of that in the EU. There were even some murmurs of that here in the United States, and now we're seeing China chime in as well. So EU countries are investigating NVIDIA. France is also investigating NVIDIA outside of the actual regional regulator for the entire EU investigating NVIDIA. There are apparatus in China that are now investigating NVIDIA for several different reasons, including anti-competitive behavior and restricting availability of chips to the country, some of which was by design by the US. But nevertheless, what's interesting about that is it does create a tail risk going into 2025. Now, it doesn't mean one needs to be inherently bearish of NVIDIA. It means one needs to be cognizant of the potential risks that the company faces. Because if you do see regulatory scrutiny, theoretically, if the European Union was to say you need to open up CUDA for all companies that have any presence or do business in EU so that they can use other GPUs on that platform, that 70% margin, which has fallen from the mid-80s to the low 80s to the mid-70s and eventually is supposed to base out in the low 70s, that margin could come down quite a bit, and that 95% data center market share could be diluted. The revenue and earnings growth could also become challenged because you'd have more competition. AMD has the MI300 series, for example, which is a formidable competitor if it were allowed to operate within CUDA, because it's about half the cost of the hoppers that are out there. And obviously we're getting Blackwell coming online, and AMD has another competitor for that, but it also has about twice the memory and it's a bit faster. So that's a bit of a value proposition if you were able to run your existing code on that hardware platform. Why does that matter? Because if you do see CUDA opened up through some kind of regulatory gavel coming down on NVIDIA, that would dilute their market share. It would slow their growth. It would become a more competitive environment. Now, it's not all bad. This would be good for AI. It would be good for research. It would be good because it would lower the cost of entry for companies getting into the space. Because if the cost of buying GPUs comes down, then being able to train models, run inference on them, and research in this area would become a lot cheaper. That would bring down the cost of entry such that we could innovate more. We'd probably also have more innovation per chip cycle. That is to say, we'd probably see bigger leaps in performance per chip cycle. Remember, tech is inherently deflationary. Over time, the amount of performance that you get and how much you have to pay for it, performance rises and how much you have to pay for it falls in time. And most semiconductors don't have terribly durable margins over long time horizons. So it wouldn't be bad. It would actually be good for much of the rest of the world if there was some scrutiny here. And NVIDIA has arguably engaged in some anti-competitive behavior over time. You can look it up if you're curious about it, but I'm not saying this is a sure thing. So it's nothing to place a bet on or sell out all of NVIDIA or whatever. It's something to monitor, right? Look at the headlines, qualify the risk, see if this impacts how you might feel about the company and where it is right now versus the risks it's facing. Because if there is a materially adverse impact on its margins and its earnings and revenue growth, that will likely lead to a price re-rating lower. Palantir is another one that had a bit of a struggle over the last 2 days. Yesterday, we saw a violent reversal candle, and then today, just a little bit of a shooting star. So that concerns me a bit because I think this one needs to settle down just a bit. It's had an incredible run. This is a company with pretty impressive growth trends, right? double to triple digit revenue and earnings growth. It's a company that continues to execute on all cylinders. It's one of the real AI stories. And what's curious about it is they're not buying hundreds of thousands of NVIDIA GPUs to be able to effectuate the outcomes they have with their AI in Foundry and Gotham. So there is a lot of AI out there that doesn't rely on GPUs or that type of computational acceleration to be able to effectuate the tasks that it does, which is important to think about. Nevertheless, I would look at Palantir in a similar light that I look at Tesla right now and MicroStrategy and some of these others. Skew has been blown out to the bullish side. That means that it's a higher risk that a left tail scenario could play out. That left tail fattens. A left tail is when you get a bit of more downside than you might expect. But on the other side, it means also that buyers have to do heavier lifting to push the stock price higher, right? So if you think about how that manifests over time, it has that sort of 1-2 punch effect. So if the broader market is consolidating, or worse yet, in a downturn, these stocks that have this blown out call skew and have had these sort of parabolic moves are a little more vulnerable. So it's not a terrible time to consider, as I was posting not long ago, selling covered calls against positions that have this sort of blown out called skew. If you're willing, again, to sell covered puts or sell puts with cash, that is to say, to have shares put back in your portfolio if you have shares called away. So that's sort of that options wheel strategy. That's one thing that I like to do with my long-term holdings to generate a bit of additional income. I'm pretty sensitive to the vol structure and how I'm going to do that. I tend to try to time it when vol's getting blown out or when skew's getting blown out, or both. We have a little bit of both in Palantir right now. So I have been doing some call selling around 80, 82.50, 85 strike just to harvest some of that premium. And again, if we get above there and my shares get called away, I'm not adverse to selling some cash covered puts. And then if we get back down to those strikes, having those shares put back into my portfolio. If you're interested in learning more about that options wheel strategy to generate a little extra income in your portfolio, it is an interesting one. You do have to have some familiarity with options to be able to execute it and not add additional risk. So I wouldn't just blindly go in. I would study it. I would make sure you have a good comprehension as to how options wheel strategies work. And, you're always welcome to reach out. If you're a member of the Traderade Discord, I'm always happy to give you some help with that. You can always ask in the questions room. Now, moving right along, we have MicroStrategy. This one is staging a defense here at the 21 EMA. So I do think that's interesting to watch. We'll see if it's able to regroup and run higher. But the overall chart pattern looks like an exhaustive parabolic move. And you see that second attempt. So you see here's the parabolic move, right? This really sharp upward move. Before that, it was a bit of a more steady grind, but this really sharp upward move, then the violent collapse, then the attempt to kind of get back up there and the failure. So the next thing that I would want to see if I was looking to either fade this or just say the momentum is out would be to crack that 21-day EMA and start to make a lower low, because you've got some gaps to fill down here. This sort of price structure is weak. You can cut right through it going the other way because you just haven't had a lot of interaction, a lot of trading at those levels. So it does leave us a little vulnerable for as quickly as we went up, we can go down even more quickly if momentum starts to shift the other way. For now, I'd say momentum doesn't favor the buyers, but sellers don't yet have a defined advantage unless we get below that 21 EMA on a closing basis. If we do, I think the chances of a flush lower to fill that gap and maybe even go lower from there are quite high. The company's strategy is questionable. There's really no two ways around that. If it was as easy as just simply filling your treasury with Bitcoin by selling 0% corporate debt, and you didn't have to have any kind of business or do anything productive in the economy, every company would do that. I would also say that if Saylor is so bullish of Bitcoin, he could take MicroStrategy's failing software as a service business and focus instead on becoming a more meaningful part of the Bitcoin or crypto ecology. Right? He could become a miner. He could become a network layer to facilitate transactions or help with e-commerce or, help run other corporate treasury strategies, something. But the fact that it's just more about selling debt and buying Bitcoin, it doesn't seem like a sustainable business strategy. And yes, the stock has had insane performance, but there's also insane risk, and you're basically paying twice net asset value to buy Bitcoin via MSTR, which means if Bitcoin's trading at like 100,000, you're basically paying 200,000 a Bitcoin and praying that the price continues to go higher. So that's just my cautionary note. It's not anti-Bitcoin. While I do think the run has been fast and furious and we are likely to consolidate for a bit here, maybe even correct, this is not an anti-Bitcoin rant. This is talking about taking the risk of Bitcoin, adding it to the risk of a company like MicroStrategy, which is, there's a lot of risk in any single company, especially with management as volatile as Saylor is, and saying, well, you know what, I'll just take those two really high beta risks together and just hope for the best. If you like Bitcoin, buy Bitcoin. If you want Bitcoin with leverage, buy Bitcoin with leverage. I would be very cautious about buying MicroStrategy, especially after all of this, given that you're not getting a discount, you're buying at a significant premium, right? So if you really like the crypto story, if you think that it's got a long ways to go, if you're like Eric Trump calling for $1 million Bitcoin, which to me is a little laughable right now, I would be more inclined to buy Bitcoin directly than buy into MicroStrategy, which as a business doesn't really have a business strategy, right? Their core business has largely failed. It doesn't make money. So I would, to replace that core business with levering up with Bitcoin is just not something I think is a good long thesis. And let's take a look at the NASDAQ itself. The NASDAQ is rolling over a little bit the last 2 trading days after clocking a new all-time high. I wouldn't be super concerned about it unless we crack that 21-day EMA. And even then, that doesn't necessarily mean we're going to have a big correction. It just means momentum may get a little bit choppy for a bit, and it increases the risk of a drawdown, right? So we're looking at this chart and saying, wow, that's been a pretty powerful move. We know that it was record inflows in November that helped to push this thing as fast and as much as it's gone. So we kind of contextualize that. There's some degree of speculative euphoria in the market, a lot of excitement out there. It doesn't show up in every single model. It doesn't show up in every single measure, but it's showing up in a lot of them. And that's enough to at least put up a yellow alert and say, okay, we need to be cognizant of how much risk we're taking on here. And here's why I say that. Yesterday, we had a small decline. Today, we had a small decline. But if you go out there and you look at some of the people posting, they're talking about Armageddon, it's the end of the world, this is a big correction or a bear market that's starting, and we've barely moved, as you can see on the chart. If people are saying things like that, it leads me to speculate that they may be too long, and the things that they're long in are also inherently volatile. It's a pretty toxic combination. It's beautiful on the way up. It feels great. But when it goes against you, that leverage can cut deeply. And so this is why I put out a thread the other day basically saying, look, I'd really like to see all of you all out here as traders for a long time to come. Next week, next month, next year, next decade, right? That means having the staying power of treating trading like a business. That means understanding you need your capital to be there next day, next week, next month, next year, etc. So that means inherently not taking super concentrated, highly leveraged risk and then just sort of praying that the market agrees with what your strategy or the lack thereof may be. I'm not saying that to be condescending. I'm saying that because with almost 2 decades of trading experience, I've seen a lot of people blow up, not managing risk first and foremost. And I don't want you or your trading friends to be one of them. So I'm only putting that out there as a cautionary note. Manage your risk first. And here's a beautiful little barometer you can use. If you're having trouble sleeping because you're worried about the market, you're in too much. Scale down. Next chart we have is the Dow Jones Industrial Average, just hanging above the 21-day EMA here. This is one that I would watch carefully if it gets below the 50. At that point, it gets a lot more choppy. For now, however, for near-term momentum, it'll be interesting if it's able to hold this 21-day EMA. We can see in some of the past sort of consolidations, it will bounce from there. So it's going to be pretty important to see whether we can stage a bounce from there. We've seen that recently as well, or whether we get back down to the 50 and sort of chop around, consolidate, and maybe build a base and start to rally back. Now, if we do make a meaningful cut below the 50, that's where I get a little more concerned that we could see some continuation of that downside as we've seen in the past. We've also got the Russell on screen, and even though it couldn't be any more different than the Dow in terms of its composition, It is showing a similar sort of setup. It's right above the 21-day EMA. Both of them are also seeing momentum on the histogram fade a bit here. So this is a similar kind of outlook. We want to see if we're bullish of small caps, hold this level. Hold the 21-day EMA, right? If not, I do think it starts to get a little bit more problematic, because if we do make that kind of retreat down to the 50 and we can't make a bounce there, it is likely we do get more of a corrective impulse. And this does look just a little bit perilous, a little bit heavy here. So if you're bullish of the small caps, seasonality is no longer as strong of a tailwind. November is the best month of the year for the Russell 2000. We're now at a time of year where you see tax loss selling become a bigger phenomenon. And, well, let's be real, a lot of the components of the Russell 2000 didn't register gains this year, particularly for people that weren't bottom picking them. So you could have some funds that are saying, oh, we've got to jettison this. Some retail holders saying, oh, we've got to jettison this because it hasn't performed too well. So that's just a risk to think about with the Russell, particularly if that decline, that momentum to the downside continues. And you'll note that it's had more red days than some of these other indices we've been watching. Now let's look at the mother of everything, the S&P 500, really the heart and brain of the market. If we look at how influential it is and how broad of a sampling it is of these large and mega cap American companies with 500 components, right? So it has pulled back for 2 days. Nothing too terrible here. We kind of got glued around 60.50 for a while. We were pinned there. Then we saw on the Traderade Discord, we talked about it as this was happening, flow moving lower to that 60.25 strike. And that really did become a bit more of a negative pull later in the day, right? I think we're probably headed down for a test of 6,000. If I had to guess, given that that is such a consequential number in the S&P 500, and we'll talk about why in just a moment here, I'd say we're probably headed down there. And if we can't hold that or the 50-day, that's where I'd get really concerned. It's early yet, right? Even if we can't hold the 21-day EMA, I would get a bit concerned about the S&P. Basically, if we build acceptance below 6,000 and we get below there on a closing basis by more than 10 points, that's where I'd say the chances of downside grow a lot. Doesn't mean it's going to be nasty downside, but you could correct. You could sell for a bit and then consolidate for a while. So it's just something to take into consideration in how you're managing risk into the end of the year, because puts are objectively cheap. And puts are not supposed to be a downside bet on the market. They're actually supposed to be a hedging mechanism, like buying some insurance and hoping your house doesn't burn down. But if it does, you get paid, right? So the idea with puts would be maybe looking at them 2 to 3, even 6 months out at the money or just out of the money. Something like that for S&P as a hedging strategy, if your portfolio is somewhat similar to the S&P or is largely in the S&P, would be what I would be looking at here. This is the big level, right? That's where all the options positioning is. We're just also hanging just a little bit above the gamma flip level, which our naive model calculates at 60.32. Why does that matter? Because if we start to get really pulled below into negative gamma, that tends to portend to continuation of selling, increased in volatility during trading hours. And if we get into that below 6,000 atmosphere, you've also got a lot of folks in calls that might start to want to get out of them because they're no longer in the money. So I would be a little bit more concerned about where vol can go under that gamma flip level, which we're kind of pinging today, but more materially under 6,000. At that point, I think the VIX can get quite a bit higher, maybe 10, 20, 30%, but you could also see the S&P correct. You could actually see a larger chance of a 10% drawdown or so, because that level has been so magnetic and such an important level of support that if we do start to push below it, I think we're kind of free to move about the cabin a little more, if you will. Now, I'm not so sure that's going to be something that happens this week or even next week. It's more likely, just based on options positioning, that it would happen after OPEX, because we're sort of stuck in some of these large gamma levels. So in my mind, and of course I'm just an observer and an analyst and a trader, but in my mind, I think it's more likely we get stuck around 6,000 for a bit, just because of how big of a level it is, how enormous the positioning is at that level, that we could get kind of magnetically drawn in and sort of chop around there for maybe another 10 days or so. Now, that all goes out the window if we have a trading day, we get below it by 10 points and see some continuation, then it's off the table, at least for that day and maybe the next several days to come. That downside risk starts to really grow. But the way I'm looking at it is it's more of a post-OPEX risk. And there's another reason for that, because after OPEX, you also have pretty much all the buybacks going into blackout. I think it's going to be about 40 to 50% of the larger S&P components especially that are going into blackout ahead of earnings, and that only intensifies from there. So you'll have several sources of flow that are important for the market kind of getting turned on their head. Now let's talk a little bit about the big picture here. We've talked about some of the internal parts of the market, some of these stocks and indices and otherwise. Let's dive into some of the things that are happening at a higher level. One of them is the rush into U.S. equities. I alluded to this a little bit earlier, and I think this is fascinating because what we saw in November was the largest monthly inflow into equities since 2000. And I do think that is a sign of FOMO. There's a lot of people chasing this market into the end of the year that feel like they've missed the rally. But that's also a little bit of a concern because we see private equity or private client holdings of equity at Bank of America rising up to 63%, right? That's the highest they've been since we sort of formed that top in late 2021. It doesn't mean that we're topping here for sure. It just increases tail risk. And this is a bit of nuance that I want to just digress and talk about a little bit. All too often, when folks share charts like this or some of the others, people will infer that it's a timing signal. It is not a timing signal. It's a risk management information data point, right? You can't just have something on a chart and say, oh, that's it. That's the top. It's over, right? When momentum hasn't cracked. I think it's more important to look at this and say, you know what? Some of these risks are building to the downside that we need to be cognizant of, and that should change how we're managing our risk in the market a bit. It means hedging is more attractive. It means delevering is more attractive, right? It means raising some cash, taking some profits in some of the more extended areas. That makes sense. But looking for a crash or trying to bet on a black swan, I'm sorry, but that's a fool's errand. And trying to time those things with any degree of consistency and repeatability is next to impossible. So it's much more about just being cognizant. What's going on? Where's the risk? Where's the opportunity? How do I, wait for it, navigate the market, right? So that's really what I'm going for here. The S&P 500 price to book ratio now exceeds the March 2000 high. So a lot of things we haven't seen since 2000. Now let's zoom out. This chart isn't necessarily the best fundamental valuation gauge, but it is one to watch. The reason I say it's not the best is because this is really more focused on tangible value or quantifiable value that can be expressed in book, but there's so much intellectual property and other intangible value that price to book is not the end-all, be-all valuation metric. But nevertheless, seeing this ramp should still put a light bulb up over our head saying, I wonder if I see things like that anywhere else. And we do see big tech valuations on the rise here. So that's another area of concern because at the same time, these Mag 7 stocks are seeing slowing revenue and slowing earnings growth. That's not the same as negative. That doesn't mean their earnings are going down and their revenue is going down. It just means it's growing at a slower rate. It's an important bit of nuance. I know many listeners or viewers are already aware of that bit of nuance, but I mention it because some folks like to say the opposite, that, oh no, they're not going into negative growth. Well, the chart doesn't express that risk. It just says the valuation, which is predicated on the idea of very high growth, may be disconnected from the reality, which is that growth is slowing a bit. And so that does open up other opportunities. And this has been my base case since we really started this year, that we should be cognizant of the risk of a slowdown in these leaders because that could create more downside potential for them, but then also be cognizant of where we may see earnings and revenue growth pick up in the inglorious 493, right? We've got the magnificent 7, and they've been well loved by the markets for years, and that's great. But if they're getting a little stretched on the valuation side, it behooves us as investors and traders to think to ourselves, are there going to be opportunities out there that are better optimized for risk to reward? And some of the companies out there in that inglorious 493 or even sectors and industries do appear a little bit more attractive in comparison. Another sign of things getting a little frothy is Bitcoin soaring with the most shorted stocks. Okay, these are things that in the latter chart, the most shorted, these are stocks that don't make money, that tend to have reasonably high loads of debt. They often even dilute their shareholders because, raising money for them is pretty expensive, particularly in this environment. Seeing them run together is giving you a sense that there's not much concern about risk here. There's much more fear of missing out on upside. So even the crappiest stocks are running, and things that are more speculative relief valves for excess liquidity, like Bitcoin, are also running as well. And again, that's not a slight, it's a reality. There's no real widely agreed upon system to price Bitcoin's so-called valuation, if we can even come up with something like that, right? So it's really much more about psychology and momentum. Well, the psychology right now that we're seeing in this chart is risk doesn't matter, buy everything that's not nailed down or on fire. That would be my concern, because we're seeing that in a number of charts. Here's another. Bearish bets flop, assets and leverage long ETFs exceed inverse products by a record. Now, obviously, the leverage long ETFs have done well, and the leverage short ETFs have done rather poorly. That's part of this, but that's not the whole story. If you look at the inflows, you can see these leverage ETFs are seeing record flows as well. So again, just a little bit of a lack of concern for risk here. People are much more concerned about missing upside than avoiding downside. And when everyone's kind of piling into the same part of the boat, right? If everyone's on the right side of it, it could get a little heavier and makes it more likely that it could topple over. And that's the concern. I'm not going to be one of those people that goes out there and says, oh gosh, the sky is falling, we're going to crash, we're all going to die. That's not my role. My role is to help to inform you. So hopefully you can make some better decisions in your trading and investing. And that's why this part is about risk. And we're going to get into some opportunities shortly. I just want to go through this because I've seen both the extreme bear view that we're all going to die and this is the next Great Depression awaiting us, and then the extreme bull view that we're just going to continue to melt up and ignore all of it. My view, like the truth often is in the middle. I think the risks to the downside have grown. That doesn't preclude us from continuing to grind higher, but we should be cognizant as to where that outperformance may come from should that happen. Now, here's single stock put call skew, and that suggests that positioning is, you guessed it, wildly bullish. So we've seen this in individual stocks. I've talked about Tesla and Palantir and MicroStrategy and some of the others. But, this is another bit of evidence that there is a lot of froth. There is a lot of fear of missing out there. And I like to say FOMO can sometimes become, oh no. And when it does, people can very quickly go from buying with every bit of capital they can borrow or inject into their account otherwise to moving the opposite way and just selling as much as they can as quickly as they can because fear can dominate pretty quickly. And then here's us. This is a chart of retail, our expectations for the next 6 months over our income, and then our expectations for the next 12 months for stock price increases. Now you'll see there's a reasonably decent positive correlation between expectations of income rising and expectations of the market moving higher in the past. But somehow this time is different. Expectations that the stock market is going to move higher over the next 12 months, plural, have hit all-time highs. Never seen anything like this, not in any of the other cycles. But income expectations have not. That's an interesting disconnect, but the bigger takeaway is just another bit of evidence to say, wow, people are really, really, really bullish. How many people that are bullish out there that are this bullish haven't already bought most of what they're going to buy? And the market needs those same folks to kind of get shaken out every once in a while get the weak hands kind of shaken out so they have to buy back at a higher price. As sad as it is to say that's how markets work, that's one reason they continue to grind higher. The other is you've got money from retirement funds and other sources continuing to pile in, foreign investments, etc. Those have also been huge flows coming into this market. But when things get extended, a pullback is healthy. And sometimes it can hurt more in the parts of the market that are very extended and very high beta and where folks are leveraged the most, because they're kind of, it's like a fire in a movie theater. People are like stepping over each other to get the heck out, slamming the, the bid if they're in a position so that, you may have in the wider spread stuff, the less liquid stuff, that exaggerates those downward moves. If you get people just selling and selling at bid, you can push down a stock much more quickly than people that are patiently waiting with limit orders. So emotion can become a factor, particularly in less liquid securities. It's just something to think about. Things can go very well on the way up, but it can feel more like climbing a set of stairs. And in those really leveraged areas, it can feel more like falling down an empty elevator shaft. The really high beta unprofitable growth, the altcoins, things like that. When they go down very quickly. So it's just something, again, if you haven't been through the whole round, the whole cycle, to be concerned about what it looks like on the other side. And again, not a prognostication, more about risk management. No one can accurately predict the future. But what we can do as traders, and to a lesser degree as investors who are less price and time sensitive, in the near term, but as traders, we can manage probabilities and try to put those probabilities on our side to the best of our ability. Another area of people getting a little too excited, garbage debt is enjoying a very low spread to higher grade corporate debt, right? So junkiest junk versus investment grade, not a good look. The average here is about 4 percentage points. We're below 3. That tells you there's a lot of complacency in credit markets. So we see complacency in crypto, in equities, at the index level in many areas, in short squeeze stocks, these really garbagey type of stocks, and also in credit markets. So to me, it just tells me to raise some cash, to put out some hedges. I'm not selling everything out. I'm not panicking. That's not how I work, right? It just tells me manage risk here. Be aware that there are some risks, and if momentum cracks, my strategy might become a little bit more aggressive about managing risk. But for now, I'm just observing and sharing my observations in hopes of helping others. We also have central banks set to cut at the fastest pace, already, in fact, cutting at the fastest pace since May of 2020, but set to cut at the fastest pace in a very long time if we see the pace of cutting continue at the rate that's been projected. I think there's about 250 cuts projected for next year globally, not just the Fed. Imagine they got that level into negative interest rate territory. It'd be extraordinary. But no, more seriously, this is a bit of a risk too. The reason it's a risk is A, there's been this many cuts so far, but B, economies aren't looking that bad. And most global central banks key off the Fed, particularly in emerging markets, but to a lesser degree, the ECB, the Bank of England, and others. So if economies are firming up and if upside inflation risks are starting to grow, well, that kind of gives you a sense that maybe we're not going to see the kind of cutting that people have been pricing in. In fact, I would not be surprised at all in about a week and a day when the Fed comes out with their December survey of economic projections or summary of economic projections, that report shows less cuts on the dot plot consensus than what we saw in September. Perhaps by quite a bit, because the picture has changed and there's certainly not the same kind of downside risks that the Fed was even looking at then. And even then, it was a stretch to cut by 50 bips in my own humble opinion. I was pretty vocal about that at the time because, look, things haven't fallen apart. And it wasn't because of monetary policy, because let's be real, it takes months and months and months, if not a year, for monetary policy transmission from the time that it's enacted to it affecting the economy and financial markets. So let's talk a little bit about opportunities, and I'm going to focus on last week's opportunities because there's a few things I want to check in on and get back to. I do share a lot of trading ideas on the Traderade Discord, so you're always welcome to check into the Trade Ideas room. We've had some real bangers lately. Even though the market's been a little choppy, there's always an opportunity somewhere. And we are two-way traders, so we look to trade upside, and when downside starts to be more probable, we'll be looking to trade and capitalize on that as well. First is DBA, and this one has been a big winner. You can see from last week, it's just been rallying higher and higher. Cocoa, coffee, OJ, other softs continuing to push this one higher. I'm in favor of taking some profits here. So on a swing long, I'd want to take about 2/3 off the table in DBA. It means I still have my runners, or about 1/3 of the position on, but I don't necessarily want to be in full size right now. I think it's had a fantastic run from when we really started to build into this position, which was, quite frankly, in early November. But I mentioned it last week because I saw it pull back, and I thought, you know what? I think we could probably get some continuation. And then there's Hack, the cybersecurity ETF. It was really looking good until the last 2 days when the broader market pulled back. I am still not particularly worried about this one unless it cracks the 50-day. I think it's time to build if we get down to the 50-day and reverse higher from there. Otherwise, if we crack the 50-day, no worries, no harm, no foul. I would close out and look for the next opportunity. And XLE, don't like it anymore. Cracked down the 50-day pretty decisively. Saw some broad weakness in the energy sector, so don't really have any interest in being long here. QQQE, we got a nice bounce off the EMA 21. If we can hold here and stage a bit of a reversal, I wouldn't mind adding a little bit to this position. But if we do break below it, I'm going to be watching how we react at the SMA 50 to see if this is going to be one that's sort of like some of the others where I may want to add a little bit there because it's an area where we have a reasonable probability of bouncing from. Otherwise, below it, I want out. RSP, similar look overall. We're just hovering now, rejecting the EMA 21. So a little more concerned about momentum on this one than QQQE. Both of these are equal weight ETFs, by the way. QQQE is equal weight NASDAQ 100. So that means if you're putting $100 into the NASDAQ, each one of the 100 companies, no matter its market cap, is getting one of those dollars, right? So it's a little more diversified than QQQ, where the weightings are wildly skewed by their market caps, and the largest 10 companies get something like 40%. So that means 40 cents of every dollar in the NASDAQ 100 that you put into the QQQ would go to just 10 companies, right? So it just depends on how you want to invest. QQQ is great. It's not like it's a bad investment vehicle, but if you're managing your risk and you see that slowdown in tech and other areas of software and tech looking a little more attractive, I'd rather be in QQQE. Going back to RSP on screen, this is another one where I wouldn't mind rebidding, adding to that position around the 50-day SMA if we see a reversal there. Otherwise, if we close below the 50-day, no longer interested in longs. Then there's gold. Gold, I think, has put in a bottom. I've been pretty vocal about that. We started talking about that bottom back here, and then we had this sort of rip and dip. And I said, after we had this consolidation, I want to see it push above the 50. We're making that push. We're closing above it today. So I think gold has room to try to run from here. It got really crowded for a bit. Everyone was talking about gold. All the gold commercials were coming back. All the gold coverage on financial media was coming back. We need a pause and a pullback to shake out some of the loose hands. But what I really like about gold that we don't see in some of the other areas that have these sort of blow-off parabolic moves, there's no parabolic move in gold. It's largely been a more steady grind higher. That's what you want to see. In precious metals, like anything else, especially stuff that's speculative, you need to be concerned about parabolic moves. They typically end very poorly, and usually they come down faster than they went up. And this is just said, having traded these kinds of markets, especially commodities, over the last, say, 18 years, because I started commodities a little bit later than just stocks, that these things can vary, especially gold and silver, where they're built on psychology and momentum, can very quickly turn around if they have a parabolic move. But we don't have that. We have a more constructive environment in precious metals, and that's what you want to see. That's good, which tells me that it's more likely that this move that we're in right now resolves to the upside, or maybe we consolidate a bit more. But the fact that we're peaking our head above the 50-day, let's see where we close the week. Let's see if we get some continuation here. If so, that'll be very encouraging. Again, my target for the first half of 2025 is $3,000 gold. And that's just been the area that I'm looking at, just like we talked about with September of this year. We were looking at $2,600 gold. We nailed that one. I'm still looking for some upside here. I think once we get to 3,000, it's going to be time to take some of that position off and reassess. Silver looks even better than gold, a decisive push higher after testing that 21-day EMA twice in a row, yesterday and today, we got a pretty decisive push higher. We can see the MACD histogram getting more and more into positive momentum, and this sort of rounded bottom look here. All this tells me it's more than likely that we can revisit these recent highs. I think momentum is really shifting. I also think it has everything to do with China. And why is that? Because China uses 15% of the world's silver supply, and about 50% of world silver is used for industrial usage. So if the Chinese economy is going to come back online with stimulus, as they keep promising, and they've said now we're going to reduce monetary policy, we're going to, make bank lending a little bit more loose in terms of the conditions so it's more available, that should ostensibly increase some degree of demand there. And if so, that should help with the price of silver over time. The United States is the biggest economy that consumes silver, so it'll also be important how our economy is doing next year. Then we have XLI. This was another idea in industrials. We are pinging the 50-day. I need to see a reversal higher from here. If we can get a reversal off the 50-day, I won't mind nibbling. Otherwise, if we close below it, I have no more interest in XLI. And we have the mid-caps. Mid-caps testing the 21-day EMA, momentum rolling over a little bit like we're seeing, in many of these charts. Again, this is a story of the 50-day. Often this one reacts with the 50-day. You can see how it can be pretty important for it. So I want to see if we're able to get a bid there or if we just pull below it. Again, if we reverse at the 50-day, I'm interested in adding. If we pull below it, I would close it out. And finally, not IWM, but IWN. This is the value Russell 2000. Okay, so yeah, declining momentum here, testing the 21-day EMA, so far holding. This is another one that if it gets back to the 50-day, I'd want to add if it can bounce a bit off of it. Otherwise, if it gets below it and basically closes below it, I'm no longer interested. So that's an update on last week's opportunities. If you're hungry for more opportunities, check out the Trade Ideas channel in the Traderade Discord. Now we're going to shift over to questions and answers. If anyone has any questions out there, please let me know. You're welcome, Wags. Thank you. He says, thanks, Markets and Mayhem. Excellent presentation as always. You are too kind, my friend. All right, one question coming in. Do I think tomorrow's CPI is the catalyst for the market till end of year? I'm going to say that the bigger catalyst right now for the interest rate complex, and then as a proxy, because the interest rate complex is usually important to the stock market, has been labor, right? It's much more about labor than inflation. It used to be inflation when inflation was sort of the all eyes concern, but the Fed has made it clear that they're more concerned about labor. So now the market has become more concerned about labor. So I think those are the metrics that are the bigger movers. And of course, we've largely had a lot of that data come out. Now we'll have, I think, some more labor market data towards the end of this month. But I think that ultimately what really is going to capture the market this month is going to be the Fed meeting. I think that's the bigger piece to the puzzle, because the Fed is going to have an opportunity to manage expectations. And what they say, both in the press conference and what is done in their dot plot and how much they may cut by, I think those will all set the tone. So what I'd be really looking for is, and my base case for the Fed meeting that's coming up next Wednesday, and I'll get more into this in a write-up on the Discord as we approach it, but I think we get 25 bips of cutting, but the Fed basically says, okay, that's pretty much enough for now. We might do another one or two next year, depending on the data, but we are becoming a little bit more concerned about inflation. The economy's hanging in there. The labor market's not cracking. So they may kind of signal that the amount of cuts the market was pricing in versus the reality that's likely to happen are somewhat divergent. And that could push up the STIR complex, or the short-term interest rate complex, a bit. And in sort of a reaction to that, that could put some pressure on equities, because you have equities that have been buoyant in part because there's this expectation of return to easier money policy. I wouldn't call it just easy money policy, because it's not likely to be that. Their lower bound rate probably closer to like 3.25%, 3.5%, far cry from ZERP and the days of TINA, or there is no alternative to stocks. But Nevertheless, it does suggest that the Fed could come in maybe a little bit more hawkish than what's largely expected. And the reason I say that is Fed speakers have been jawboning that all the way up to and including Chair Powell, right? He said similar that he believes that there's a little bit more firmness in the economy, less risk to labor market. We are hearing Fed speakers talk a little bit more about their concern about inflation. Now, it's not uniform, but that's also because they tend to float trial balloons, right? They tend to kind of jawbone different types of policy outcomes to see how the market reacts. So my base case is that the Fed's meeting will be more pivotal for what sets the tone. And what's interesting is that meeting comes, then we have December OPEX, and that week we also have buyback flows slowing materially as more companies go into blackout ahead of earnings. So all else being equal, the key is going to be where are we in relation to S&P 6,000 at that moment in time? If we're pulling below it, I'd be pretty concerned that we get some decent continuation lower. But if we're able to build a base there and we can defend it through some of these volatility catalysts, and maybe the Fed doesn't come out as or isn't interpreted as hawkish as they are, that could be seen as a positive. But if Powell comes out and says, look, we're pretty much done with cutting, maybe another one or two, we're going to be much more data dependent, then I think the risk is going to be that we could start to push lower and we could see a little bit of repricing of risk in the interest rate complex and in the equity market, and particularly in stocks that are growthier, in stocks that are longer duration risk, and stocks that are unprofitable. Those would be the areas where I'd see a risk. And I think it would create some risk for, kind of peripheral areas like crypto as well. So that I think is the big kind of deciding point as we get closer to the end of the year. And of course, it could be a non-event. We could get to that day, it comes in exactly as the market expects, and we don't get a big reaction. But of all the event volatility catalysts that we have left on the December calendar, that's the one that I really have my eye on. Inflation data, unless it comes in, say, with a downside or upside surprise that's meaningful, it doesn't necessarily tend to move the dial nearly as much as it used to. Like we all remember in 2022 and early 2023 especially, everyone watched CPI. You had tons of volatility. You'd have these crazy, just very dynamic trading days before the market opened, like right as the data was coming out and into the market open, and even the first hour or so. Those days seem to be more of a distant memory. The risk with CPI now is we're seeing core inflation really start to become sticky, right? At a rate of about 3.3% year over year, but also if you annualize the last several readings, it's a similar rate. And that's higher than what the Fed would want to see, and it would also give them reason to have some degree of pause about how much cutting they do. So let me know if that is helpful. Yeah, you've got it. All right. And since the election, we've seen a positive correlation of U.S. equities and U.S. dollars and the U.S. 10-year note. That's abnormal by my account, as both correlations are typically negative. Any thoughts on why flows are driving these correlations to positive values? That is a great question, Wags. I love it. And I love where your mind is at, because you're looking at these intermarket dynamics and putting together these pieces of why isn't this behaving as it had previously. So my first thought is that rates are moving higher because there is this presumption that we're going to have a fiscal agenda that maybe builds the case for some degree of term premium on the long end at some point. That would mean, uninverting. That would mean either flattening out of the yield curve or ideally seeing the long end priced at a premium to the short end to convey the risk you're taking, buying longer duration exposure. I think that's part of it. I think part of it is also on the shorter end of the curve where we're seeing rates push up as well, that we're sort of repricing the Fed. We're seeing some degree of upside economic surprises, some stickiness to inflation. That also gives us cause for rates to move higher. The dollar, from what I can see, has been largely kind of either leading rates or rates leading the dollar, but it tends to be kind of one way or the other most of the time that they're positively correlated. That is to say, the 10-year rate and the U.S. dollar tend to see a high degree of positive correlation. There's other reasons for that. You look at exchange rates, where's capital going to flow? Well, if rates are going up in the dollar denominated risk-free asset, you're going to be more likely to want to buy that, and that helps to draw demand into U.S. markets. That helps to firm up the dollar as well. So I think that those two things are kind of bound together. And I'm just kind of laying that bit of narration out there for the next part of the story. That, you're right. It's very unusual that you see a strong dollar and rising rates benefit the market, particularly, over the last several years. It was more of like, I think, a early 2024 story, if I recall correctly, that we saw a bit of that. But it's not often that you see that. But I would say there is a line in the sand, and that is 4.5% on the 10-year. What we tend to see is when we move above that level, markets become more nervous about rates. I think there's a variety of reasons for that. I think it's basically because the cost of capital globally is continuing to go up and probably past a point where a variety of debtors that are probably on variable rate loans get a little more sensitive. And this hits emerging markets doubly hard because they have to deal with the fact that rates are going up on their debt, and then they have to repay it in dollars, which are becoming more expensive. So there's a certain point where rising rates and a rising dollar does become a risk factor. Right now, I think that it has a lot, also the rising dollar part has a lot to do with foreign flows coming in enormous size. We have lots of money coming in from overseas chasing US assets, and that helps to give a little bit of a bid to the dollar as well. And then we also have Trump's treasury pick largely being more of a strong dollar advocate and them kind of walking back the weak dollar policy. So I think it's a convergence of different things, but I do have a cautionary note. The amount of folks that are shorting some of these different areas on the yield curve, particularly the 5-year note, and then the amount of folks that are long the dollar and short things like the euro and the yen, that's all getting blown out. It's getting a little bit extended. So I would say that some of that may in the near term consolidate a bit or maybe even come down a bit. That rates could come down a little bit, that the dollar could come down a bit. Obviously, CPI and the Fed are going to play a bigger role than flow and positioning, but flow and positioning suggests that these moves are getting just a little bit extended in the near term. So let me know if that is helpful. It was a bit to unpack, as it were. Yeah, you're welcome. So folks, we're going to wrap it up there. Been going at it for about an hour. This has been a lot of fun. I really appreciate everyone tuning in. I hope that you got a lot of value out of this. Of course, if any other questions come up, feel free to reach out anytime. I'm always happy to help. And if you didn't get to catch this whole thing, I will be posting the recording shortly. So thank you all for everything. I appreciate you all. Catch you soon.